What's up, guys? It's Rowan
and Terry
from Artist Smart TV, bringing you
another episode of the HSC Economics Review.
So what are we covering, Terry?
So as Rowan promised in the previous video, we are looking at monetary policy, and we're going to be doing a fairly intensive deep dive of it, probably deeper than most of the textbooks out there, because I have read the textbook recently. We just found that, there's a lot we could actually say, and I think it's really useful as well because we said that we want to connect this to one of our essays that we predicted for the HSC 2022 exam. So more specifically, we thought inflation and the policies used to address inflation would be one of the topics that come up in an essay, and one of the key policies that we would love you guys to talk about in your essays with regards to inflation is monetary policy. So that's what we're here for, to look at how well and how terrible they have done.
And I think the other thing that makes this a really awesome time to dive in is that right now, I think there's been some really great analysis coming out that's being quite critical of the role that monetary policy may have played over the last couple of years. And so particularly if you've got an analysis evaluate style question, we're going to be diving deep and giving you a lot of stuff that you can really use to bring in to really just elevate the quality of your analysis in the effectiveness of monetary policy in grappling with inflation, full employment and all of the issues. So let's kick off maybe just with, first of all, what's the recent policy settings look like,
okay.
Terry?
Yeah, so just to give you guys a quick recap, once the COVID, well, even before the COVID pandemic, really, we were operating at quite a historic low, interest rate. We were just over, 1%. Then when COVID hit, I remember we had that March 2020, we aggressively dropped it twice within that month, all the way down to, I think it was 0.25%.
Yeah.
Right. And then by the end of 2020, we'd gone all the way down to 0.1%. Right. So it's as low as we could have gone without getting down to zero.
Yeah.
We sustained that up until the start of this year. And then we had what I like to call the V-shaped recovery. Right. And so we've just been aggressively. So if I look at these decisions here, we've got, 6th of April. They were still at 0.1% 2022. 4th of May, they've got an increase of 0.25. 8th of June, 0.5 increase. 6th of July, 0.5 increase. 3rd of August, 0.5 increase. And 7th of September, also 0.5 increase. Now, this video is being filmed before they make the decision for October. Yeah. But there has been plenty of talk for October that they're also going to go with a 0.5%
That's right.
percent increase. So that will take, at the moment, we're at 2.35% of the time shooting this video. But by the time this video is out, it's probably going to be
a bit more.
Yeah.
And a big part of that is, and we'll dive in a little bit more, but for the RBA, they're really looking at, in some respects, taking the cash rate back to a neutral setting. Okay, and so there's this idea that roughly a cash rate close to the 3% range, right, is considered a neutral setting in that, it's having a fairly neutral impact on, the economy in terms of, economic growth, inflation and the like. So at the moment, we're not even at a neutral setting. If we just put this in not the last couple of years, because it's been a weird environment, but we zoom out, right? So I think that's just an interesting bit of context. Now, of course, why really quickly, Terry? I know we've got a separate video on inflation. So if you want to know more about what's happening with inflation, you should go and watch that.
Absolutely.
But just briefly, so we have a little bit of context here. Why have we seen such a rapid increase in the cash rate?
Well, the only thing that's been more rapidly increasing than the RBA's cash rate is the inflation rate, right? And so when you think about your economics theory, you should understand that one of the components of inflation is demand pull inflation, right? And that if you can increase your monetary policy cash rate, that will try to slow down and discourage a little bit of that demand pull inflation and bring it back down a little bit. But really, it's almost like they were caught what's called flat-footed. They had no choice, really. It just started to take off without them, and they were just chasing. They were playing the catch-up game.
Yeah, and to be fair, it isn't just the RBA that are facing this challenge, right? Really, central banks across the world are playing a catch-up game right now. And again, Australia's inflation relative to the global economy is relatively good. So you could argue that...
And it doesn't feel that way.
No, it doesn't feel that way, but it still is. So we're playing catch-up, but we're not playing as much catch-up
as the others.
Yeah, as some of the others. Now, I guess one of the things that's interesting here is if we now sort of look at this. So we've had the RBA increase the cash rate, right? I think let's dive in a little bit to what their rationale is about why they've been doing this. And then what I'd love to do is look at, okay, a little bit of like, what is some of the analysis, the criticisms, the evaluation that we can do, not just of their recent increase, but more bigger picture over the last couple of years. Because part of the criticism right now, very briefly to just highlight it before we get to the rationale, is that, well, like, it's just jumped from, from 0.1 to 2.35 in the space of a couple of months. Like, it's one of the quickest increases, right? That we've seen in almost 30 years, right?
And I think for a lot of our viewers who are studying in Year 12, like in their time that they've been in high school, they didn't realize the RBA could do this.
Yeah.
Like
increase the rate.
Yeah, like what?
Is the RBA allowed to do that?
Yeah, I thought they would need to decrease it, right? So jumping into the rationale, as you said, right? So I think as we pointed out, it's because they have significant concerns about the rate that inflation has been increasing, right? And so they look at it and they say, well, yes, a lot of that, and we covered this in the other video, a lot of it is coming from global factors. There are obviously still some domestic factors at play, like for example our labor market, right? As we also mentioned, there's been a very low unemployment rate, and just jobs being filled. But basically, they're just going to keep rising this rate until they get that inflation to peak at around 8%, as we said in another video as well.
That's right.
And then that's what they consider to be, as you said also earlier, that neutral rate of around 3%.
And so I think if we think about it, right, like they're expecting medium-term inflation to really still be well anchored and to come back to their 2 to 3% range, right? That's their sort of long-term expectation. But it's interesting, they do anticipate that, by 2022, they're expecting it to get to 7.75, 7.75, 7.75, right?
Yeah.
Which is crazy high, right? Almost that 8% we talked about, but they're still expecting to be above 4% in 2023 and 3% in 2024. So when the RBA says medium term, they're talking a couple of years, right? They're not talking about, next year she'll be right, it'll be all fine, right? Like, it is going to still be significant. And I just want to highlight, if we go back to our separate video we did on inflation and wage growth, like we were looking at negative real wage growth, right, at the moment. It's gone back 3.5% right now, 5% probably by the end of the year. And if we're still looking at inflation next year of 4%, we're probably still looking at negative real wage growth, maybe of 1 to 1.5%, right? So you're still certainly going to see some implications there. It does mean, though, that the RBA is expecting ongoing interest rate rises, or cash rate rises, to be accurate, right? Timing, they're not committing to, right? It's interesting. Right now, they're being quite coy on the jawboning, right? And that's one of the criticisms that we're going to unpack in a moment. So that's probably a nice transition.
Yeah,
right?
Yeah, let's go for it.
There's been a number of criticisms of the RBA. Now, it's interesting, during COVID, they were sort of hailed as a bit of a hero, right? With the big budget expenditures, like amazing, RBA killing it, coming in, unconventional policy, they've got, quantitative easing kicking in. Now it's changing a little bit, right?
Yeah, so, just to put it in Gen Z terms, Ron, so they were slaying before, but now they are being caught out for gaslighting. Yeah. Now, I just want to explain.
That's actually a really good...
No, because this is what I've been saying to my students all year, and they've picked up on it. So they have, in a way, because when you talk about jawboning, it is a form of, let's just say, economic gaslighting, right? It is. It's just trying to get people to do things, influence the way that they think, the way that they behave, based on what you're saying. So the first thing I want to point out is that there was, during that COVID period when they absolutely dropped the rates down, there was a lot of concern, like how long are we going to stay in this really low period? And there was a conversation, and there was a lot of I won't lie, I felt gaslighted, because I remember seeing this, that there was this idea that the rates wouldn't increase until 2024. Then I went back to Google, and for some reason I couldn't find much about it. So I'm like, what's going on here? No, but I do remember. So now that now that you've said, you've also heard it.
Oh, definitely.
Yeah. So both of us have heard it. Like, I'm not making things up.
No. I mean, Governor went on the record, right? And this is the thing that was quite interesting. One of the things that, jawboning, I mean, they called it forward guidance, but ultimately it was jawboning, right? Where they're trying to influence expectations in the market, right? To behave in a certain way. So what they were trying to do is say, look, guys, the interest rate's not going anywhere. It's going to stay really low for a long time. And so the argument then was, well, okay, great. We should go out and borrow lots of money, right? Because if the interest rates are low, awesome. We don't need to worry too much about, how we're going to necessarily pay for it if the interest rate goes up. Let's go and spend. And I think the really big criticism that's emerged here, okay, is that ultimately, they've now rapidly increased the rates, okay? I remember reading, and I was just trying to find to see if I had it here, but I don't think I do. One of the Green senators, and okay, putting aside your political affiliation, he was calling for the governor to resign because he's like, you've persuaded and convinced everyone to go and take debt, right? And on the premise, on the statement, right, rates won't rise until 2024. And now what are you doing? You're jacking it up in 2022, arguably at least 18 months, if not, more than that earlier. And so you can sort of see why, people feel like they've been gaslit.
Yeah, no, absolutely. And I think what's interesting also about this is that he's come and backtracked.
Yeah.
Right, and he's come out and said, well, I haven't actually broken any promises because my original promise, which is like, honestly, this is abusive behavior, right? This is what someone who's abusing you does, right? Like he's come back and he's changed his words. He said that what he said in like 2021 when he said the rates wouldn't increase is that it was highly conditional, and the condition was that once we'd reached full employment, we would then start to think about, But then at the same time, that we didn't think that we'd reach full employment so soon, right? So it doesn't matter which way you peel it, right? At the end of the day, the guy has gone back.
On what he was saying.
On what he said.
That's right.
Yeah.
Now, look, there are some other factors at play here. Of course, you've got, the Russian invasion of Ukraine, right, played out, and the RBA was reluctant to maybe, do some things to deal with inflation sooner. Because part of the other criticism here, sort of, to be fair, the RBA is caught between a bit of a rock and a hard place right now. On the one hand, they're getting criticism for upping the rates because it was against their forward guidance. So there's a lot of criticism there. On the flip side, they're now getting criticism because people are going, well, we've got inflation and it's eroding real wages. What is monetary policy doing? Why didn't monetary policy get on top of this sooner, right? And so you can really see that the RBA has been caught between these two very difficult positions. Now, the governor said, well, look, the reason we didn't act sooner was because of Ukraine, right? It was like, look, we didn't know how that was going to play out, right? We didn't want to jack up the rates even earlier and then discover that the Ukraine war had, even more significant impacts than it's had on the Australian economy. So you can sort of see, okay, cool, understand that, right? And that's partly where, according to the European Central Bank, they have argued that about 3/4, if you can weirdly statistically define.
Yeah, because we talked about this in another video. It's very difficult to actually figure out where the inflation's coming from.
Yeah, right. But they've claimed that 3/4 of the surprise in inflation came from really the Ukraine conflict, right? Like in the fact that they were surprised by it, and 3/4 of that surprise was Ukraine. So I don't know how you worked it out.
They were 3/4 surprised.
Yeah, that's right. That's what the European Central Bank has to say on the matter. Okay. So I think you can sort of see where there is a little bit of criticism here, okay, on both sides. Upping it, problematic, but also not upping it, problematic.
I want to also just, on my point about the decision-making process, I want to mention that the RBA's board isn't actually made up of, bankers. Yeah. They're actually just, they come from all walks of life. Some are in, influential business people, right? So, when they are making these decisions, it's up to what the RBA is giving them in terms of information, right? And at the end of the day, if you want to be critical, that's fine. But I think we also need to understand that the people who are part of this board who make this decision together, they're not all bankers, right? So not everyone in that board will have known or foreseen these circumstances, right? Because we all, with the benefit of hindsight, everyone's always right, right? That's right. So just to stick up for the board.
Of course, I agree.
Yeah.
Now, one of the other things that's interesting about this is that there have also been calls for a review of the RBA. Okay, as part of the fact that they took, very, historical action, right, in terms of the fact that, there'd been no precedent for the level of, QE in Australia and certainly the level of quantitative easing that occurred in Australia. There's been calls for a review of the RBA and its policy objectives. Now, it's actually one of the few central banks across the world that has not had a review, okay? So suggests maybe, okay, that's a reason to do so. Now, why might there be calls for a review, Terry?
Well, I think if we first of all recognise that there's just been so much, just scrutiny, right, from media, from just the regular population, right? People are demanding answers, right? Another one is just, as you said before, because when other countries are doing it, you know, Australia as a player in that global economy, we do often need to make sure we're, at least we don't do exactly the same thing as everyone else, but we're on the same page because we want to be, you know, like cooperating with other countries. But most importantly, right, I think we're starting to question whether our inflation target of 2 to 3% is actually what we want.
Yeah, that's right. And I think a big part of that is just fundamentally, the RBA didn't meet it for 6 years anyway, right? Like, let's be honest. It's a target, but we're not meeting it. So is it actually, and they're not expecting it to meet it again, maybe until 2024, but probably maybe 2025 if we're being honest. So that's going to put the inflation target almost at like an 11-year period, right? If you sort of zoom out, that maybe it hasn't been met. So I think ultimately there's got to be a consideration. Is it the right fit, right? Now it's interesting, the United States did a review through all of 2019. It changed its inflation target through that process, right? The European Central Bank, the Bank of Japan, the Bank of Canada, the Reserve Bank of New Zealand, all of them are in the process or have just completed it, okay? And all of them have taken a really hard look at their inflation targets. So one of the suggestions that's emerged from these reviews, and this is something that, you know, you can put in if you're doing a bit of like analysis on an evaluation on the, you know, the RBA's success in achieving inflation objectives, right? Is that maybe what might be better is what's called price level targeting, right? Rather than an inflation target. And what that is rather about trying to get inflation above its target, right? For a little while to make up for inflation shortfalls. So the idea is rather than trying to get in the range, it's recognizing that if it's been below for a period, maybe it needs to be up for a period, right?
Yeah, because I think we touched on this very briefly in another video. Like prices, it's at the end of the day, what matters is the price. And you know, when you have a high period of high inflation, you know, prices won't go back.
No.
Right. So having this arbitrary target that you're setting is probably not what you want after a period of very, very high inflation. You probably want it to be a little bit low, and I think it just makes sense. At the end of the day, we are focused on prices because that's what people see. Right. At the end of the day, an inflation rate for the general population means nothing.
And I think the inflation target, I mean, Australia followed the globe in terms of central banks across the world in the 90s to set an inflation target, and that was based on a review at the time of, you know, the Australian economy and the conditions and the needs of the Australian economy. You would argue the Australian economy has changed significantly since the 1990s, right? Which does indicate there's probably a good cause for this.
Yeah. And another point about just the introduction of the inflation target in the 90s was that it actually worked, right? Yeah. And so, you know, when something works, you keep it. But once it does no longer, as you said, like it hasn't worked in 6 years. So why are we keeping something? You know, that doesn't work. So just another, I guess, reason
that you could bring.
Yeah.
Now, part of what we should also consider here, guys, if you're doing a bit of an evaluation of monetary policy, is the fact that, you know, the RBA had a significant... Now, it's really interesting. The RBA never really used the words quantitative easing. They were very good at avoiding that language.
I tell you what, they're just abusers.
Yeah, they really are, aren't they? But ultimately, their bond buying program, which they affectionately call it the BPP, right? With really a quantitative easing, right? BPP. B double P. Bond purchasing program, right? But I think what we need to do here is we do need, and the RBA has done a recent review of this as well, so it does give you a way to analyse the effectiveness of, you know, the alternate forms of monetary policy that were implemented over the last couple of years, right? Which you haven't had up until this point. Up until this point, it's all been roses, right? Like, yes, bond buying, great, it was something that they did, but now we've actually got some data.
Yeah, I just want to disclaimer, like, I actually, over like last holidays, I was at a teacher's event where people from the RBA actually spoke to me about this. So if you don't mind, I might just kind of refrain a little bit because there's some stuff that I've heard, but I'll just go over like some objective stuff if that's okay.
Yeah, of course. Of course. So ultimately, this is from the RBA itself anyway, right? In terms of their own review, as well as looking at a couple of analysts in the economy in terms of what they've sort of said about it. But fundamentally, just for you guys who have maybe forgotten or haven't got your head around the bond buying program, right? I think it's worth us just pausing for a moment. So initially, what happened was the government, the RBA, I should say, 3rd of November 2020, they announced that they were going to, as part of a second package of monetary policy to support COVID, they were going to implement a bond buying program. Now, that was originally going to be $100 billion of government bonds that had maturities aimed at 5 to 10 years. Now, these were not bonds that they bought directly from the government, okay? Because that would have been literally printing money to give to the government to fund the deficit. They were buying second-hand government bonds. So the government would sell some bonds, banks, superannuation houses, mum, dads, whoever would buy the bonds. When they were going to sell it on the secondary market, the RBA would use the $100 billion that they identified to go in and buy those bonds. Now, ultimately, they extended this program several times, okay? So they extended it in February 2021 for a further $100 billion, okay? And then they extended it again in September 2021. And eventually, okay, it finally ended in mid-February 2022. Now, all up, okay, they ended up spending $281 billion, or I should say they purchased $281 billion of government bonds, okay? 224 of them were by the Australian government in terms of federal government, and 57 billion were state and territory.
I'll jump in. Like, the number I got was different from that. That's...
Oh, interesting. Well, this is from the RBA's review.
That's what I'm saying.
Yeah, so do they not know what they've done? Because
I don't know, Ron.
Well, to be fair, that was one of the things that did come up in the data that I did see, was that there are some questions around, apparently the program was a little messily run, okay? At least this is what has been publicly, and to be fair, it was the first time they've ever done anything like this in Australia. They were doing it under very exceptional circumstances. So for now, I would be quoting this data because it is the official RBA review data that they have shared. Whether or not it gets updated and changed in time, okay, we will see, okay? But for now, this is what the RBA in their official review have shared. Now, ultimately, their RBA have estimated, okay, that at the end of the day, the effect of this was to reduce the yield, or the interest rate, of government bonds by around 30 basis points to record lows. So I just want to pause for a moment, Terry. How does buying bonds reduce the interest rate, and why would the RBA be trying to reduce the interest rate on bonds? Like, what's the purpose?
Yeah, so I can talk about this because there's no opinions attached to this. So,
there was no opinions attached to that. That was the numbers from the government's bond buying review. Let's be clear about that.
Go for it. Anyway, so as you were saying, Ron, so when you purchase a bond, well, first of all, what a bond actually is it's a debt instrument, right? And any debt instrument has interest attached to it. And it also, because it's traded on a secondary market, it then can be bought and sold at a certain price, right? Yep. So there's an initial price for the bond, and then once it's bought and on the market, it can be bought and sold for different prices.
So just before you continue, right, a debt instrument, the best way to think of it is like an IOU. Okay, so it's like you pay $10 for this piece of paper that says bond, right? And it'll guarantee you X% interest payment for the life of that bond, or the maturity rate, 5 or 10 years. If it's 10% and the bond's $100, you will get $10 a year for 10 years. Simply put.
Yeah, and I love that we're keeping it simple, because in an essay, you don't have enough time to really just give this beautifully detailed, explanation. But B, it's just easier to understand, because the main point is that we just need to understand what happened at the end.
Yes.
So once you have that bond on the market, you can buy and sell it. And the RBA, obviously, if they come in with all this, this undefined amount of money that they spend, right? That they spent some money, and that creates, demand for these products. And as you guys know in the course, as you increase the demand for something, the price of it will go up. Now, the issue is that if the price of the bond goes up, then the return or the interest on that bond, or the yield, right, is actually going to go down. So those are inversely related.
That's
the price and the yield inversely related. So if you increase the price, the yield is going to drop down. But what's more important
that's because ultimately the bond, the yield is already, like, arguably it's been fixed, right? You were buying it at X%, but if you're then spending more to buy that as a percentage of the price,
then your actual yield is a little bit lower.
That's right.
On paper, it's the same. But
yes.
Yeah. So then the end result of this, right? If you drop the yield, right? Why do you think they've then wanted to actually?
Well, because one of the big problems, right, is that they'd already dropped the cash rate at that point to 0.1, okay? And one of the big challenges is that there's a time lag effect from the cash rate moving into the economy. B, there's just also the fact that the banks weren't passing all of that on, right, to the economy in the interest rates, because it was impacting banks' profitability. So how do you then actually influence the interest rates in the market? Well, the RBA's got to find a way to more directly intervene in the market, right? Because the cash rate is not, right? It's really just through the exchange settlement accounts with the banks. So bond buying actually enables the RBA to go into a particular market and they go to the 5, often the 3 or 5, there's 3 years, there's 5 years, there's 10 years, right? They'll go into certain markets that are usually used as like key indicators of interest rates in the economy. And then that's why they picked this market to go directly into it, to lower the interest rate, because they couldn't do enough of it via the cash rate itself. That's why they were doing it, fundamentally, okay? Now, at the end of the day, their claim in their review paper that is published on the RBA website is that it lowered it by 30 basis points. So in other words, it was successful at least in lowering the market interest rate for bonds, okay? And therefore, lowering the interest rate, remember, the broader effects of that is that it encourages us to spend more, to consume more, and to drive greater levels of consumption and economic growth in the economy.
Yeah, because just one thing I want to quickly just touch on is that when you lower the bond rates, they're often seen as, like a benchmark just for other interest rates in the economy. So you drop those ones as like a benchmark, everything else is just going to start to move.
So again, right, the RBA's gone, well, we tried to use the cash rate, which is again one lever that has a far-reaching impact. It didn't work. Let's go into one market directly and see if we can do that, because that's then another signal ongoing, right? So now, one of the big things we need to think about here though, right? Because one of the criticisms that's been sitting pretty it's like burbling, it's like gurgling along, it's like not massive, but it's there, is, well, to what extent did QE contribute to our inflationary pressures, right? Because at some level, the way the RBA buys these bonds, right, is that they're basically printing money, right? Now, in essence, they're not really with a machine spitting out notes, but because they're basically buying these, and they're paying, most of the time they were buying these bonds off the banks, okay? So all they were really doing was creating a new credit and exchange settlement account for the bank, right? So it was digitally created, but at the end of the day, still money that wasn't in existence before. And if we think about basic, monetary theory, okay, the principle is that increases in the money supply, right, create inflationary pressure in the economy because we've got more money chasing the same amount of goods, okay? And so one of the things we need to then consider is, okay, to what extent did QE maybe contribute to some of the inflationary pressures that we're experiencing?
And I really want to emphasize, we're going, very, very far beyond what you probably look at just in your course anyway. So I guess one of the key formulas, if you're going to go down that monetary path, is just looking at the money supply times the velocity is equal to the price times, I think, the quantity of goods and services. So basically, just to sum all that up, because you really don't need it all, right? Yeah. It's just that, if you increase the money supply and you also keep the same velocity, as some of you who do maths and physics and stuff would know, is like this speed that something's moving at with direction, right? So don't cancel me, mathematics people, right? So if you keep that same speed though, so the rate that money is being respent, almost like the multiplier effect, right? If you keep that the same and you increase the money supply, and you don't actually increase the quantity of goods, what's gonna fly up is the price, and that's what we've been saying. Yeah.
And so I think the sort of thing here is the RBA have again tried to come back and say, well, look, no, we don't think QE has contributed, and the reason for it is they've said well, look, yes, there is more money, okay, but you've got to look at where that money is going, okay, and we've got different things. We've got money base, right? We've got M1, M3. We've got different calculations of money supply, but at the end of the day, what they've said is that a lot of that money is still sitting in bank accounts that hasn't been spent, okay, and at the end of the day, that means the velocity is actually
quite low.
It's quite low, right? And so if we're trying to look at inflation now, a lot of that money is still tapped away, right? And so their argument is, well, look, velocity is low based on, the sort of data that's available, which indicates that it's probably not the driver of the inflation that we've seen. Now, in saying that, though, will the velocity increase in time, right? Well, that's plausible. And arguably, maybe the inflation data we shared in the prior video is starting to show a little bit of that, because we saw big increases in, recreation, transport, clothing, footwear, furniture. So if we're looking at the CPI data and where we're seeing growth, right, in that, it's not just all driven by increased supply side costs. There is a demand side there that is kicking in.
So I just wanted to also jump in, Rowan, about that point about velocity. So the RBA has actually also made it very clear that they've understood this velocity, and in their decisions to increase the cash rate, they have actually noticed that like when they were considering how this would affect, affordability and existing mortgage debt, they realized that people actually have a lot of savings tucked away.
Yeah.
So one of the things they did say, and I don't know if this is on the record, but one of the things that they did say to me was that they understand that there's a lot of room to increase rates because people have saved.
Yeah. We're months ahead on average on typical mortgages, right?
Yeah.
So they know that, there's the capacity. In some sense, that's how they deal with the increased risk of velocity, right? Yeah. You increase the rates, and yes, people have to draw into those savings, right? Yeah. But where those savings go is into mortgage repayments.
And I think that's where also people get really upset, though, is people won't notice that they're ahead of their payments. They will just go any moment where they have to draw out, right? They'll get upset. So I think
to be fair, though, on the flip side, right, the debt to income ratio for households was pretty intense for the average purchase price of a property. So at the same time, it's like, well, yes, we're ahead, but it was also our first opportunity to make a dent, right? At some level. So it's a complex beast.
It is.
Maybe the final thing to highlight here, and then we'll wrap here, is that what is happening now is a transition from quantitative easing to quantitative tightening. Okay, and so this is something that you could probably reference because it is the end of quantitative easing and the end of the bond purchase program. So this tightening basically is where the RBA is holding the bonds. They're not selling them, and there's an important reason why they're not selling them, because if they just go and sell all these bonds that they bought, if they need to do QE in the future, right, the market won't trust that they're buying the bonds and they're going to hold them, right? And there's going to be an expectation that they're going to dump them and then the bonds aren't really worth anything, okay? So they need to almost hold the bonds and let them run out in terms of their maturity for it to work in the future if quantitative easing is needed again. So what they're doing fundamentally, guys, is they're holding the bonds, okay? And they're going to let them mature. So that means they'll let them play out over the next 5-10 years, okay? And unwind gradually. Now, ultimately, I think as part of this, right, this goes to your point, Terry, and is that they're also doing this because they don't believe it's the best way to deal with inflation, right? I think the cash rate is what they've sort of identified. So they said, look, at the end of the day, the best way to reduce the stimulus is not to now jump in and sell the bonds. It's actually to hold it because it creates policy confidence in the long term, and then use the cash rate as the main lever.
I think,
yeah, of course.
So I think what that also, you can then reveal a little bit about your understanding of inflation and monetary policy is that it doesn't have to necessarily be symmetrical. What you do when the cash rate is low or when inflation is low, it does not necessarily have to be the opposite when inflation is high.
I.e. sell the bonds.
Yeah. Just because you bought bonds doesn't mean you have to sell them.
Yeah, that's right. That's exactly it. So there we have it, guys. I mean, a bit of a deeper dive into recent monetary policy, and also now that we have some data, whether or not RBA data, we're sort of going to rely on it as much as we can. We've got some data on the effectiveness of the bond program, right? And we've also got what's coming in terms of the transition, and some analysis there that you might want to use around the inflation target and a review of RBA objectives. If you have any questions about it, let us know in the comments. Any final comments, Terry?
Yeah, I just think it's very important that you do make up your mind. So we've given you a lot of information, really, and it's up to you to actually go ahead and process that and synthesize it and then give an evaluation of what you think, because we think that's what's going to pop up in the HSC exam.
Yeah, awesome. There you go, guys. All the best for your HSC Economics exam, and see you in the next video.